I'm good, thanks. I hope you heard our conversation, mine with Joe Terranova a short time ago, where he suggested that the market is in a better place. We are in a better place, is what he said. I said you were going to take issue with that. Is that true?
Yeah, look, I think, some businesses are in a better place because they've taken the medicine and they're set up for, tougher times. As Joe rightly pointed out, good CEOs are acknowledging that. That's what they should be doing. However, those tougher times we think are going to get a lot tougher. And what we're talking about specifically is margin and profitability. So we're seeing it in the numbers. I mean, this has been our call, as you know, for the last 9 months. So I would say 9 months ago, that call was up for question. It's unequivocal now, Scott. I mean, you talk about it on your program all day. I mean, the operating leverage is going in the wrong direction. I mean, Texas Instruments is another good example where the operating profit, missed on a margin basis and also on a dollar basis. And we're seeing that all across the economy today with, Union Pacific specifically cited that. They talked about operational inefficiency. It's a theme we've had all year. And we think that theme is only about halfway baked. And it's all wrapped around this idea around inflation, which is confusing, right? We haven't had inflation like this in, any of our careers, really. And so what's happening is inflation now is coming down, but costs are sticky. And it's the opposite of what we saw in 2021. And we just think that people are underestimating the magnitude of this negative operating leverage cycle, which is made worse by inflation coming down faster than expected.
Hasn't the market already adjusted, though, to all that you just suggest is still to hit it? I mean, we absorbed a pretty good body blow on the fact of what the Fed was embarking on and the impact that all of that hiking would have.
Yeah, look, I mean, I think the market has absolutely digested the Fed. And we talked about that back in October. That's why we went tactically bullish, as you know, when we were trading at 3,500 and we were trading at 15 times earnings. We felt like that was actually a decent pitch. It worked. Liquidity was better at that point, too. But now we're at 17.6 times earnings again, Scott. And now the numbers are actually going to finally come down in a way that we didn't think would happen in Q4, which it didn't. But now we think that's happening. So we would argue against what Joe is saying. We think the market's in a worse shape because the equity risk premium is lower today, which means the market's not worried about risk. It's still focused on the Fed, which it should be, because the Fed's not going to be cutting rates anytime soon. But remember, rates are lower. We already had the multiple expansion from that. So unless you think rates are going to drop here precipitously because we don't have a recession, that seems unlikely, then it's hard to argue for higher multiples to offset any earnings degradation.
Would you admit that the economy is stronger at this point in the hiking cycle than you thought it would be?
Oh, I mean, that is actually a very good question, Scott. I mean, a year ago, as you know, we were talking about the Fed was going to have to go harder. If you had told me the Fed would be able to raise 450 basis points on their way to 500, and we wouldn't already be seeing, a labor cycle, a more dramatic labor cycle, a hard landing, I'd be surprised. So, yes, I have been surprised at the resilience, but that just speaks to the incredible savings that was built up. The stimulus has lasted longer than perhaps we thought it could. But the Fed has recognized that, right? And so they've gone harder and they've gone higher than anybody expected over a year ago. And that's going to have lasting impact into 2023.
But doesn't it speak also to the great place that we were in, and the size of the cushion is a lot bigger than you and others suggested it might be?
Yeah, but that's played out now, right? So now the earnings are going to start to roll over because that we believe that the consumer now is going to show signs of weakening, which we did. We saw retail sales softer in December. We saw the services indices, the key ones that we focus on, that are suggesting the consumer is starting to fade, not a collapse, but not spending at those rates that they had been, which have been, keeping the economy stronger than what I would have guessed.